Hey guys, this is Toby Mathis with your next 4 of 8 rules of how to trade and the biggest mistakes beginning stock investors make. So we're going to go over the second of 8, the second 4 categories of biggest mistakes beginning investors make. You ready? Number 1, and this is number 5 is forgetting to charge rent on your stock. Could you imagine buying a house? So you buy a house and it's going to be a rental property. And you buy it and you hope it's going to go up in value. And you're sitting there and you forget. You're like, gosh, there's something I forgot to do. And you hold this investment property. And let's say, it's over, it's in the section of town. You can walk by it every day. And every day you walk by, you go, there's just something I feel like I'm forgetting to do. And every day you walk by it. And then one day, like 10 years later, you realize, well, wait a second. You know what? It's been costing me money these 10 years. It's gone up a little bit in value, but I knew there was something I forgot to do. I forgot to rent it out to a tenant and let them pay for all the holding costs and and all the expenses. I forgot to have them pay for the property taxes. I didn't have any rents coming in. In the stock market, we do that too. Now, most people will buy a stock and they say, okay, I buy a stock and it doesn't cost me anything to hold, right? It just sits in my account. There's lots of opportunity costs. There's money that could be generated. I'm just holding a company and I'm hoping it goes up. There's a lot of things I'm missing. Number one is I want to get paid to own it. And in order to get paid to own it, there's 2 things that need to be occurring. Number one, it needs to be paying me dividends. And number two, I need to be renting it out. And the way that you rent out stocks is you sell options to third parties to pay more than what you paid for that company. Or better yet, no matter what you paid for, let's say you bought a company at $10 and now it's at 100. You sell somebody the right to buy it from you for 105 or 110 or 102, something more than what it's worth. And they're going to pay you to do that. And I call that renting out a stock. There's ways to roll out of that if the stock starts to go up. Don't worry about that. You learn those things. But the important lesson and the big mistake that beginning investors make is they don't realize that they should be renting out the stock and they give up that income stream, which accounts for about half of the gain on a lot of these companies. Like if you really want to get technical, if I buy a company and I hope it goes up in value, a lot of that value is because it's retaining its earnings. So if it's not paying out the dividend, there is a little bit of makeup. I would rather be paying out the dividend because I'd rather have that money in my pocket now. But let's just say like that one, there's a little bit of offset, but there is no offset for not selling the option, not renting the stock out. You never get that back. You're paying, somebody is paying you for the time, the option time, that value. And if you don't do it, you lose that value. And so that's a big mistake. I'll call it mistake number 5 that beginning investors make is the failure to rent out. The 6th reason, number 2 on this chart, but the 6th mistake that beginning investors make is buying more of a falling stock. I have a very simple rule. I'll only buy things when they're channeling sideways or when they're going up. The trend is your friend. If you buy something that is falling, they call it catching a falling knife. It can be a painful experience, right? You don't want to try to do that. Let the knife fall. Once it stops and sits there for a while, then pick it up, right? But don't go chasing after it. And we see this when people are convinced because they're using emotion instead of logic. And they'll say, man, that thing's going to come back. There's another great quote from a trader, Paul Jones. Where you want to be is always in control, never wishing, always trading, and always, first and foremost, protecting your butt. That is a great quote because it's talking about, hey, always be looking at this. You want to be in control of this situation. You don't want to be hoping that the company turns back. You don't want to be wishing and hoping. And you don't want to put yourself in a situation where you're going to risk. If you buy something that is trending downward, that means that there's pressure pushing it down. There's people dumping it. That's what's causing it. It doesn't have a value. There's not as many people asking for it. Companies that have a lot of people asking for it go up or sideways, worst case scenario. And so you don't want to try to buck against that. So just wait for it to channel or wait for it to start trending up. If you miss that bottom, so be it. You can buy it on its way back up. You don't have to worry. You don't shed a tear. What you don't want to be is buy it halfway down through its loss and then it just continues to crash on down. Pretty frustrating. All right. Number 7. This is the 7th on our list of 8 mistakes that beginning stock market investors make. And this is a big one. Do not invest with borrowed money. It's really dangerous. People are going to offer you to do things on margin and they're making an interest rate. It becomes a big fat liability to you. And I know you may say, but I'm going to outperform it. If somebody gives me 1%, maybe I'm taking that money, right? Maybe I'm taking it because I know I'm going to do better. But in the stock market, there are no guarantees. I would not put myself at risk. Time is your friend. And if you borrow, we don't know that time frame. If you're doing things on margin, it's very easy for someone to say, I am going to call your margin and I'm going to make you pay me back right now. And even if the company is down in the toilet and you're waiting for a bounce back, they're going to sell it. And you're going to freak out and you're going to say, why are you doing this? And they're going to say, because I have a contractual right. So we don't want you doing things on margin. And then there's also another good quote that comes along with investing with borrowed money, which is win or lose, everybody gets what they want from the market. Some people seem to like to lose, so they win by losing money. If you're somebody who does not know whether you're the market winner yet, do not exacerbate this. And because you're giving away the money, you're making a mistake that unfortunately is bouncing back and now hitting you twice as hard because you put yourself at risk by borrowing the money. Just don't do it. The last mistake beginning investors make that I really want to talk about, and this is a huge one, and this is why I tend to be here and why folks like myself and our organizations, I'm a tax attorney. I love people making money because it creates tax issues for guys like me to help solve, companies like mine to help solve. Like, if you didn't have tax issues, it's because you don't have a money problem because you're not good at making it, right? So we got to make sure that you're good at making it. And that is the last one is they don't continue to learn. And one of the best investors on the planet in history, 95-year-old Charlie Munger, I think he's 95 now, he's in his 90s, had a very good quote, which is, in my whole life, I have known no wise people over a broad subject matter area who didn't read all the time. None, zero. You'd be amazed at how much Warren, meaning Warren Buffett, reads and how much I read. My children laugh at me. They think I'm a book with a couple of legs sticking out. And there's a lot of truth in that. People that are good investors tend to bring in information. And why do they bring in information? Because information and knowledge trumps fear and uncertainty. It's an old adage when people would get up and do public speaking and things. The best thing you can do is prepare, because that's going to help calm you. When you're prepared, you tend not to get nervous, right? If you prepare, you tend not to be subject to emotional changes. Like if you know what you're doing, like if I buy a good company, a solid company that's paying out a good dividend, and I know that company, I've researched that company, and it starts to fall, I'm not nervous. What I do is I say, well, that's illogical. That doesn't make a lot of sense. And I know that it's going to come back. Well, guess what? The market is irrational. The market is illogical. The market does stuff all the time that makes no sense because it's driven on, to a certain degree, pure emotion. People go on TV and the talking heads and they do the soup du jour of the day and they talk things and companies go up. They have no business going up. Companies go down. They have no business going down. And in the day, what wins out is patience and having being resolute about what you're investing in because you're confident, because you've done your research. And your research comes with doing your reading, making sure that you're constantly filling your brain so that you're making sure that you understand so that you are not tricked into making emotional mistakes. And there you go. We have the 8 big mistakes beginning investors make.